This video is for anyone preparing to sell life insurance in Arkansas, and it covers only what Arkansas does differently. Everything you are studying about how life insurance works in general, the policy types, how cash value builds, how beneficiaries are named, lives in your national study material, and we are assuming you are working through that separately. What we do here is narrower and, for your exam, just as important. The state portion of your licensing test asks about Arkansas law specifically. The deadlines Arkansas sets, the dollar limits Arkansas guarantees, the rules Arkansas writes for producers like you. Get the national side from your national course. Get the Arkansas side, the part that trips people up, right here. A quick word of reassurance before we start. None of this is hard once you see it laid out plainly. There are a manageable number of Arkansas-specific numbers and rules. The exam tests them in predictable ways, and by the end of this video, you will know exactly which figures to lock into memory. We will repeat the ones that matter until they stick. Let's get into it. Start with who is in charge, because every rule we cover traces back to one office. Insurance in Arkansas is regulated under Title 23 of the Arkansas Code, and the agency that enforces it is the Arkansas Insurance Department. You will hear that name constantly, so we will use its initials, AID, from here on. At the head of the department sits the Insurance Commissioner, a single official with broad authority over everyone who sells insurance in the state. What does the Commissioner actually do? Think of the role in three parts. First, the Commissioner issues and revokes licenses, which means your ability to work depends on staying in good standing with this office. Second, the Commissioner writes and enforces the rules that fill in the details of the statutes. Many of the specific requirements we will cover come from numbered department rules, not the code itself. Third, the Commissioner investigates and penalizes violations, holding hearings, issuing orders, and examining the records of companies and producers. When you picture the Commissioner, picture a regulator with the power to license, to make rules, and to discipline. Now, connect that to companies. Before an insurer can sell a single policy in Arkansas, it must hold a certificate of authority from the Commissioner. That certificate is the company's permission slip to do business in the state. An insurer that holds one is called an admitted or authorized insurer. An insurer that does not is unauthorized, and it is generally not allowed to transact insurance with the public here. This distinction matters more than it first appears, and here is why. The safety net we will discuss at the end of this video, the Guaranty Association, only backs policies from admitted insurers. Sell a policy from an unauthorized company, and your client loses that protection entirely. So the certificate of authority is not paperwork trivia. It is the dividing line between a protected policy and an exposed one. On your exam, remember the chain of command. The state regulates insurance under Title 23. The AID enforces it. The Commissioner runs the AID and holds the power to license, write rules, and discipline. And no company sells here without a certificate of authority. Keep that structure in your head, and the rest of the state material hangs neatly off of it. Next, we turn to how you personally get licensed. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Becoming a licensed producer in Arkansas follows a clear sequence, and the exam likes to test the order and the specific requirements, so let's walk it carefully. A producer, by the way, is simply the licensed individual who sells, solicits, or negotiates insurance. The term Arkansas uses for what you may think of as an agent. The first requirement is education. Before you may sit for the licensing exam, Arkansas requires you to complete 20 hours of pre-licensing education for the line you want. That is 20 hours for life. If you were also pursuing health, that would be its own 20 hours. Say that number again to yourself, 20 hours per line, because it is a common exam target. Your certificate of completion is good for 2 years, so you must pass your exam within that window. With your prelicensing certificate in hand, you apply. Arkansas runs producer applications through the National Insurance Producer Registry, an online system you will see referred to as NIPR. You submit your application there, and you complete a criminal background check through the state's online portal. The department reviews your application, and once you are approved, you receive authorization to schedule your exam. The exam itself is administered by a private testing vendor called PSI. We will save the test day details for the end, but know now that you must pass it before your license is issued. Once you pass and your application clears, Arkansas issues you a permanent producer license. The word permanent here is meaningful. Arkansas does not make you requalify from scratch each period. Your license continues as long as you renew it on time and keep your continuing education current. There is also a faster, temporary path in limited situations. Arkansas allows a temporary producer license that is valid for a period not to exceed 180 days. That number, 180 days, is worth memorizing because the exam likes to pair it against permanent licensing to see if you know the difference. A temporary license is a short bridge, often used to keep a business running after a producer's death or disability while a permanent applicant gets qualified. It is not a shortcut around the exam for the long term. It is a 180-day stopgap. One more piece. If you are already licensed in another state and you move to Arkansas, you generally do not have to start over, and you may not need to retake an exam. Arkansas, like most states, recognizes non-resident and incoming licensees, so producers relocating here should check with the department rather than assume they must repeat everything. Let's recap the licensing numbers you must lock in: 20 hours of prelicensing per line, a certificate good for 2 years, a permanent license once you pass, and a temporary license capped at 180 days. Mix those up, and you will lose points. Now that you are licensed, the next question is how you stay licensed and how you get tied to the companies you represent. Holding a license lets you sell, but it does not by itself connect you to an insurance company. That connection is called an appointment. An appointment is the formal notification that an insurer has authorized you to represent it. Here is the Arkansas timing rule, and it is precise. When an insurer establishes that relationship with you, it must file your appointment with the department within 15 days. The clock starts either when the agency contract is signed or when the company receives your first piece of business, whichever happens. 15 days, that is the insurer's deadline to get you on the books. Appointments in Arkansas also share a single renewal date. Rather than each appointment renewing on its own anniversary, all appointments renew annually on June 1st, and paying that renewal is the insurance company's responsibility, not yours. When an insurer wants to end its relationship with you, it files a termination, and notice of that termination goes to the department within 30 days. Your own license runs on a different and very specific clock. Arkansas renews producer licenses on a 2-year cycle tied to your birthday. Your license expires on the last day of your birth month, every 2 years. So your renewal date is not a random date the state assigns, it is your own birth month. Whether you renew in an odd or even year depends on your birth year, but the anchor is always your birth month. Lock that in. Your license is good for 2 years and expires at the end of your birth month. A few housekeeping rules round this out, and the exam does ask about them. If you change your name or your address, you must notify the department within 30 days. Notice that 30-day figure keeps reappearing for address changes, for name changes, for appointment terminations. Arkansas leans on 30 days as a standard reporting window, which actually makes it easier to remember. And if you let your license lapse, Arkansas does allow reinstatement for a limited time after expiration rather than forcing you to start over immediately, though you will pay an additional fee and you must have your education complete. So the pattern here is 2 clocks. The appointment clock belongs to the insurer. 15 days to file, June 1st to renew, 30 days to terminate. The license clock belongs to you. 2 years, ending the last day of your birth month, with 30 days to report changes. Keep those two clocks separate in your mind, and the appointment questions become straightforward. Next, the requirement that actually keeps your license alive between renewals, continuing education. Your license does not renew on good intentions. To renew, you must complete continuing education, which everyone shortens to CE, and Arkansas sets a firm number. Producers must complete 24 hours of continuing education every 2 years. Of those 24 hours, at least 3 must be in ethics. Say those two figures together because they travel as a pair on the exam. 24 hours total, 3 of them ethics. We'll repeat that, 24 and 3. A couple of details Arkansas builds around that requirement are worth knowing. If you earn more hours than you need in a cycle, you may carry the excess forward to the next period, up to a full 24 hours of carryover. But there is a catch the exam likes. Extra ethics hours carry over only as general credit, so they do not satisfy next cycle's ethics requirement. You have to complete your ethics fresh each renewal. There is also a sensible grace for newly licensed producers. You are not expected to complete continuing education for that very first partial period, so the requirement kicks in for your first full renewal. Beyond the general 24 hours, Arkansas requires special training before you sell certain products, and these are favorite exam material because the numbers are specific. Take long-term care insurance, the coverage that pays for extended care like nursing homes and in-home assistance. Before you can sell it, you must complete an initial 8-hour long-term care training course. After that, you complete a 4-hour ongoing long-term care course every 2 years to keep selling it. Picture it as 8 hours to start, 4 hours to maintain. Annuities carry their own training mandate, and this one matters for a life producer because annuities are a life-licensed product. Before you sell, solicit, or negotiate an annuity in Arkansas, you must complete a one-time 4-hour training course on annuities. We will come back to why Arkansas cares so much about annuity sales when we reach the best interest standard. But for now, fix the number. A one-time 4-hour annuity course before you sell your first annuity. Here's a tip on how these fit together. That long-term care training and that annuity training are not piled on top of your 24 hours as extra burden. They count toward the 24. They are requirements about what you must study, layered inside the total you already owe. So the structure is 24 hours every 2 years, 3 in ethics, with specific product training folded in before you sell those products. Let's recap the continuing education numbers, because they are dense and heavily tested. 24 hours every 2 years, 3 hours of ethics each cycle, carry over up to 24 hours with ethics carrying only as general credit, an 8-hour initial plus 4-hour ongoing long-term care course, and a one-time 4-hour annuity course. Those are the figures the exam will hunt for. With your licensing and education settled, we move to the heart of the state material, the policy provisions Arkansas writes into life insurance contracts. This is the section where the most exam points live, so we will go slowly and repeat the critical numbers. Arkansas law requires certain provisions in every life insurance policy, and while several mirror the national standard, the exam wants you to know Arkansas's specific figures. If you studied national material and absorbed a number, this is the place to check it against what Arkansas actually says. Begin with the grace period. The grace period is the stretch of time after a premium is due, during which the policy stays in force, even though the payment is late. Arkansas requires a grace period of 30 days. If a premium goes unpaid on its due date, the policy does not lapse immediately. The insured has 30 days to pay, and during that window coverage continues in full force. We'll say it again, 30 days. And here is the fair play rule that rides along with it. If the insured dies during the grace period, the death benefit is still paid. The insurer simply deducts the one premium that was due from the proceeds. So a late payment never costs the beneficiary the whole policy. Picture a quick scenario by ear. A premium is due on the 10th of the month, and the policyholder doesn't pay it. 3 weeks later, still inside the 30-day grace period, the insured dies. Is the benefit payable? Yes. The policy was still in force because the grace period had not run out. the insurer pays the death benefit and subtracts the unpaid premium. That is exactly how Arkansas's 30-day grace period is meant to work, and that is exactly the kind of fact pattern the exam builds a question around. Next, the free look. This one matters because the world outside this exam is full of bad information about it, and you need the correct answer. A free look is the period right after you receive a new policy during which you may return it for a full refund, no questions asked, as if it were never issued. Arkansas law requires a free look of 10 days on individual life policies. A notice of that right must be printed right on the first page of the policy. If the policyholder returns it within those 10 days, the policy is void from the start, and every dollar of premium comes back. 10 days, that is the Arkansas figure. Now the trap, because there is one. Arkansas's 10-day free look applies to ordinary individual life and annuity policies, but the statute specifically carves out Medicare supplement policies and variable products, which follow their own separate free look rules. So if an exam question asks about the free look on a standard individual life policy, the answer is 10 days. Do not let a distractor talk you into thinking Arkansas has no free look at all. It does, and the number is 10. Move to incontestability. The incontestability provision sets a deadline after which the insurer can no longer challenge the policy based on errors or misstatements in the application. Arkansas sets that period at 2 years. Once a policy has been in force during the insured's lifetime for 2 years from its issue date, it becomes incontestable. After that, the company cannot void it for a misstatement on the application. 2 years, and notice the exam's favorite contrast here. Incontestability is 2 years, while the free look is 10 days. Those protect different things at different stages, and swapping them is a classic wrong answer. There are 2 narrow exceptions to incontestability, and they are reasonable once you think about them. The policy can still be contested for non-payment of premium, because no one expects coverage you stopped paying for to stay in force forever. And it can be contested for fraud in the procurement, although Arkansas lets an insurer choose to give up even that exception and make the policy fully incontestable after the 2 years. The point to carry into the exam is the core number, 2 years, with non-payment as the standing exception. Now, misstatement of age. People sometimes get their birth date wrong on an application, and life insurance premiums depend heavily on age, so Arkansas has a fix that is fairer than simply voiding the policy. If the insured's age was misstated, the benefit is adjusted to the amount the premium actually paid would have purchased at the correct age. Walk through what that means. If someone understated their age, they were paying too little for their stated coverage, so the death benefit is reduced to what those premiums would have bought at their true older age. The policy is not canceled. The benefit is simply recalculated to match the money that was actually paid. On your exam, when you see misstatement of age, anchor to that idea. Adjust the benefit to what the premium would have purchased at the real age. Do not deny the claim. Finally, reinstatement. Reinstatement is the process of restoring a policy that has lapsed for non-payment. Arkansas allows it, and the key feature the exam tests is what the insured must show. To reinstate, the policyholder must provide proof of insurability, evidence they are still an acceptable risk, and pay the overdue premiums. That proof of insurability requirement is the heart of it. Reinstatement is not automatic, because the insurer gets to confirm the person is still insurable before bringing the policy back. Let's recap the provision numbers you absolutely must memorize, because this is the densest cluster on the test. Grace period, 30 days. Free look, 10 days on individual life, with Medicare supplement and variable products excluded. Incontestability, 2 years. Misstatement of age, benefit adjusted to the correct age rather than denied. Reinstatement, proof of insurability plus back premiums. Burn those 5 in. When we transition next to claim payment, you will see Arkansas attach one more number to the back end of the policy's life. Once an insured dies, how fast must the company pay? Arkansas addresses this directly, and the figure is clean. When a policy becomes a claim by the death of the insurer settles upon receiving due proof of death. Arkansas law says that if the insurer specifies a period before which it will settle, that period cannot exceed 2 months from the receipt of the proofs. In plain terms, the company has at most 2 months from proof of death to pay the claim. Be careful here, because this is precisely where secondary study guides go wrong and where the exam sets its trap. The Arkansas claim settlement outer limit is 2 months, not 30 days. 30 days shows up elsewhere in Arkansas law for grace periods and reporting deadlines, so it is a tempting wrong answer. But for paying a death claim, the statutory ceiling is 2 months from proof of death. If you see a question asking how long an Arkansas insurer has to settle a life claim, anchor on 2 months. Why does the state set an outer limit at all? Because the whole purpose of life insurance is to deliver money to a grieving family when they need it, and an open-ended payment window would defeat that. By capping settlement at 2 months from proof, Arkansas makes sure a valid claim turns into cash within a defined, reasonable period. Understand that purpose, and the rule answers itself. Recap: proof of death triggers payment, and settlement cannot exceed 2 months. Next, we look at a feature that lets a policy pay out while the insured is still living. Not every life insurance payout waits for death. An accelerated benefit, sometimes called a living benefit, lets a policyholder receive part of the death benefit early when they face a qualifying condition such as a terminal illness. Arkansas regulates these benefits through a department rule, and there are 2 features the exam likes to test, so let's name them clearly. First, the payment form. Under Arkansas's rule, the policy must offer the accelerated benefit as a lump sum. The insurer cannot force the insured to take the money as a stream of installments or as an annuity. Why does that matter? Because someone facing a serious illness usually needs flexibility and immediate access to the full amount for care or expenses, not a trickle of payments. So the rule guarantees a lump sum option. If an exam question suggests an insurer required the accelerated benefit be paid only as an annuity, that is a violation. The lump sum option must be available. Second, disclosure. Because accelerating a benefit reduces what is left for the beneficiaries and can have other effects on the policy, Arkansas requires the insurer to give the applicant a clear disclosure showing how taking the benefit affects the death benefit, any cash value, premiums, and any policy loans. The idea is informed choice. The insured should understand the trade-off before pulling money out early. Here's the way to hold this for the exam. Accelerated benefit equals a living benefit, paid early for a qualifying condition, with a required lump sum option and a required disclosure of its effects. The trap is the payment form. Remember, the insured cannot be forced into an annuity. Next, we turn to one of the most heavily regulated activities a life producer engages in: replacing an existing policy. Replacement is when a new life insurance policy or annuity is bought, and in connection with that sale, an existing policy is dropped, surrendered, lapsed, or otherwise used up to fund the new one. Arkansas regulates replacement tightly through a department rule, and the reason is straightforward. Replacing a policy can genuinely harm a consumer. They may restart a contestability period, face new surrender charges, or pay higher premiums at an older age. So the state surrounds replacement with disclosure duties designed to make the customer stop and think. What must you, the producer, actually do in a replacement? The core duty is notice. When a sale involves replacing existing coverage, you must present and give the applicant a written replacement notice, a document that spells out, in plain language, that a replacement is occurring and urges the customer to compare carefully before giving up what they have. The applicant signs it, you sign it, and the customer keeps a copy. You are also required to list the existing policies being replaced, and the replacing insurer must notify the existing insurer that its policy is on the chopping block, which gives the existing company a chance to reach out and present the customer with what they would be losing. The why behind all of this is consumer protection, plain and simple. Arkansas is not trying to ban replacement. Sometimes a replacement genuinely serves the customer. It is trying to guarantee the customer makes the decision with eyes open, fully informed about the costs of switching. Once you understand that purpose, the paperwork requirements stop feeling arbitrary. And this leads straight into a prohibited practice you must never commit, one we will revisit shortly. It is unlawful to push a replacement through misrepresentation, to talk a customer out of a good existing policy by misstating its features or the new ones. That specific abuse even has a name, twisting, and Arkansas treats it as serious misconduct. For now, hold the replacement essentials. A replacement triggers a signed written notice to the applicant, a listing of the policies being replaced, and notification to the existing insurer. Next, we examine why annuities, in particular, carry an extra layer of protection. Annuities deserve their own section because Arkansas, following a national model, holds producers to an elevated standard when recommending them. An annuity, briefly, is a contract that can turn a sum of money into a stream of income, often used for retirement. And because annuities are frequently sold to older buyers and can carry long surrender periods, the state pays close attention to how they are sold. The governing idea is the best interest standard. Under Arkansas's annuity rule, when you recommend an annuity, you must act in the best interest of the consumer. That means you cannot place your own financial interest, or the insurer's, ahead of the customer's. This is a meaningful step up from the older, weaker idea that a sale merely had to be suitable. Best interest asks more of you. In practice, Arkansas's rule breaks the best interest standard into obligations you should be able to recognize on the exam. There is a care obligation. You must have a reasonable basis to believe the annuity effectively addresses the customer's financial situation, needs, and objectives, which means actually gathering information about them before recommending. There is a disclosure obligation. You must tell the customer about the annuity's important features and about your role and how you are paid. There is a conflict of interest obligation. You must identify and avoid or manage any material conflict between your interests and the customer's. And there is a documentation obligation. You must keep records of the basis for your recommendation. Care, disclosure, conflict of interest, documentation, 4 obligations, all aimed at one goal, the customer's interest first. This is also where that annuity training requirement from earlier connects. Recall that before you sell an annuity in Arkansas, you must complete a one-time 4-hour training course. That course exists precisely so that you understand the best interest standard before you ever make a recommendation. The training and the standard are 2 halves of the same consumer protection effort. On your exam, if you see a producer steering an older customer into an annuity with a long surrender charge, mainly to earn a higher commission, recognize it for what it is: a violation of the best interest standard, specifically the conflict of interest and care obligations. Recap the annuity essentials. Act in the customer's best interest. Satisfy the care, disclosure, conflict of interest, and documentation obligations, and complete your one-time 4-hour annuity training before selling. Now we widen the lens to the conduct rules that apply to every life sale you make. Arkansas, like every state, outlaws a set of unfair and deceptive practices in the business of insurance, and the exam expects you to recognize each one by name. These are the actions that get producers fined, suspended, or stripped of their license, so they are worth learning not just to pass the test, but to protect your career. Let's define them in matched plain terms, because the exam loves to give you a scenario and ask which one it is. Misrepresentation is making a false or misleading statement about a policy's terms, benefits, or value. Twisting is a specific kind of misrepresentation used to convince a customer to drop an existing policy and replace it. Misrepresentation in the service of an unnecessary replacement. Churning is closely related but stays inside one company. It is using the values built up in a customer's existing policy to fund a new policy with the same insurer, again without real benefit to the customer. Here the family resemblance. Twisting and churning are both replacement abuses, one across companies, one within a single company. Rebating is offering a customer something of value not stated in the policy, a share of your commission, a gift, special favorable terms, to induce them to buy. Arkansas prohibits rebating because it distorts a fair marketplace and can pressure customers into decisions for the wrong reasons. Defamation is making false, damaging statements about another insurer or producer. Coercion is using force or undue pressure, for instance, threatening to withhold something a customer needs to compel an insurance decision. And unfair discrimination is treating people in the same risk class differently, charging different rates, or offering different terms to individuals who present the same actual risk. A spoken scenario to make one of these concrete. A producer tells a client that their current whole life policy is worthless, which is not true, and on the strength of that false claim, persuades the client to surrender it and buy a new policy from a different company. What has the producer done? That is twisting, a misrepresentation used to drive a replacement. If the same producer had instead used the old policy's cash value to roll the client into a new policy with the very same insurer on a false premise, that would be churning. Same dishonesty, different mechanics, different name on the exam. One more conduct rule deserves a direct call-out because it connects to our final topic. A producer may never use the existence of the State Guaranty Association as a selling point. You cannot reassure a hesitant buyer by telling them a state fund will bail them out if the insurer fails. Arkansas, and every state, flatly prohibits using Guaranty Association coverage to induce a sale. Keep that one ready, because it leads us straight into what that association actually is. Let's recap the prohibited practices to recognize on site: misrepresentation, twisting, churning, rebating, defamation, coercion, and unfair discrimination, plus the rule against using Guaranty Association coverage to sell. Learn each definition because the exam tests them by scenario, not by dictionary. Now, the safety net itself. We close the content with the Guaranty Association because it brings together several threads: admitted insurers, consumer protection, and a set of dollar limits the exam very much wants you to memorize. The Arkansas Life and Health Insurance Guaranty Association is a safety net created by state law. Every insurer admitted to sell life, health, and annuity products in Arkansas must belong to it. When a member company becomes insolvent, unable to pay its obligations, the association steps in and pays covered claims, funded by assessments on the other member companies. Notice the connection back to certificates of authority. The association only protects policies from member insurers, which are the admitted authorized companies. A policy bought from an unauthorized insurer gets no association protection at all. That is the practical payoff of the admitted versus unauthorized distinction we drew at the very beginning. Now, the numbers, and these are the dollar figures the exam will press you on, so we will state them plainly and then repeat them. For anyone insured life, the association covers up to $300,000 in life insurance death benefits. For annuities, it covers up to $300,000 in the present value of annuity benefits. And there is a higher ceiling for one special case, up to $1,000 for a single contract holder's unallocated annuity benefits, the kind tied to certain retirement plans. Let's say the core pair again, because they anchor the section $300,000 for life-death benefits, $300,000 for annuity present value. A subtle but tested point about how these limits stack. The $300,000 limit on life-death benefits is an aggregate per insured life with any one company. It does not multiply by the number of policies. If a customer held 3 separate policies with the same insolvent insurer, the association still caps the life-death benefit protection at $300,000 total, not $300,000 per policy. The exam loves this because the intuitive guess is that more policies mean more coverage. They do not. One insured life, one company, $300,000 maximum on the death benefit. And recall the conduct rule we just covered. Although this protection is real and valuable, you may never use it to sell a policy. The association exists as a backstop, not a sales pitch. Let's recap the guarantee numbers to memorize: $300,000 for life insurance death benefits per insured life, $300,000 for the present value of annuity benefits, and $1,000 for one contract holder's unallocated annuity benefits, with the death benefit figure being an aggregate per company, not per policy. With the safety net covered, only one practical topic remains: the exam itself.